No problems. I'm going to share with you the notes. Okay, so now what you have with you? Notes, isn't it? Any of you?
Yes, doctor, the note.
Okay, you have a notes with you now. Okay. So we're going to proceed with your note. Last time we start up to which slide? If any of you still remember slide 40, set 40, 40, 40, 40, 40. It's 40. We get it. Okay, about this one, yeah? Okay. Okay, okay. Okay, so just want to continue. Just continue with this one, yeah? Okay, we have consolidation procedure. We have an example of this one. So just want to discuss with you about the step here. Okay, the steps here we have okay, the step. Okay, so method that we're using here. So we just proceed with this one. This one is a revision for what we need to do for consolidations here. Okay, method that we are using here is methods is why I'm using my pencil. Okay, we are using the acquisition method. Okay, acquisition method. So this acquisition methods view a business combination from the perspective of acquirer. We just want to look at the perspective of the acquirers here. Acquirers here means that the parents. We're going to focus on the parents based on the parents' view of account. Yeah, okay, perspective of acquirer. So the acquirer purchased the net asset and recognized asset acquired and liability those and contingent liability assumed, including those not previously recognized. So the acquirers here, parent need recognize all the asset plus the liability, including assets or liability which is not yet recognized. Yeah? Okay, so this is what you have recognized. So you need to recognize all. The acquirer record the assets and liability at fair value. So the asset and liability should be recorded at fair value. Okay, so the step that we have here, we have 4 steps here. The first step here, we need to identify. Okay, we need to identify who is the, I need to look at, okay, this one a little bit. If you have anything, can you just voice out? Because this chatbot sometimes is block the notes that we have here. Yeah, okay. So to apply the acquisition methods, we need to identify who is the acquirer or who is the parents. Okay. And then we're going to look at also the acquisitions date. So the acquisitions date, try to find which one is more. Okay, want to know who is the acquirer, who is the parents, and then the other one is acquisition date. When is the acquisition date? So for acquisition set, you have to be careful. Yeah, once that one is related with the stage acquisitions. Okay, stage acquisition, let's say on 1st of January 2014, you have a share of 20%. During this time, there is no controls yet. Okay, and then let's say in 2015, you add another 20%. Now it become 40%, not yet controls. Okay, let's say in the year 2016, 1st of January 2016, you add another 20%. Now you become altogether 60%. So 60% starting from this date, since that you have a control, so the acquisitions date will be on 1st of January 2016. So that is will be your acquisition date, the date when you have a share more than 50%. Okay, and then the next step, you need to recognize and measure the identifiable asset acquired and liability assumed and any non-controlling interest in the acquired. So we need to measure all the asset and also in NCI. NCI here is in the case when the parent has a share less than 100%, then you're going to have the NCI. Yeah? Okay. Recognize and measure the goodwill or the gain from a bargain purchase. Goodwill here in the case when you have your purchase price here is more than net identifiable asset, then you have goodwill. And then bargain purchase here in the case when the purchase price is lower than net identifiable asset. So this one will be recorded as a gain, gain and then transfer to the income segment. For the goodwill here, it's become your asset and then this one transfer to a financial positions. Okay, that is four step. Yeah, I'm not going to discuss about the details about the four step. We already done about this one. Okay, just one about this one. Just on focus about this one. Okay, so this one is about the acquisition expense. If there is any cost that are incurred during the acquisition process, we're going to treat that cost as an acquisition expense. So this acquisition expense here, either if that one is a paid, you're going to credit your cash. Okay, and then if that one is not yet paid, not paid, and then you're going to credit a payable. So any payable. So debit your acquisition expense and then credit the cash or payable. It depends whether paid or not paid. Okay, we have done these examples. Okay, for this example, you have to be careful, yeah, because it said that for a consideration to board another companies here, you may use a cash, okay, cash, and then you have a liability. This liability, because the liability amount 2 million here is going to be paid on 1st of January 2019. The acquisition date is on 2017. So this liability need to calculate for it present value, present value. Okay, and then issue of 1 million shares at the price of 4 ringgit. So this one you need to time with the for the shares capitals here. Share capitals here is number of shares time with number of shares here time with market value. Okay, and then we have the acquisition cost of 500. Yeah? And then give you the ABC incremental borrowing cost here is 8% per annum. Yeah? 8% here is used to calculate for this present value. So 8% here, and then the end here is equals to 2 because you have 2017 and 2018. Beginning 2017 and 2018 because the payment here is only on 1st of January 2019. So we only have 2 years. Yeah? Okay. So this is what we have. We already calculate last time. Okay, so the immediate cash considerations and then the present value of the deferred considerations. You have 2 millions. Okay, another things here to calculate for a present value, you can use the tables. Okay, the tables here is a PV tables, 8% to, or you can calculate it. Okay, to calculate here is using the formulas here. The value of the liability, okay, 2 million time with 1 over formula. The formula here is 1 plus I or some R interest powered by N. And here is a period. So this is if you want to use a calculator, you just can calculate this one. This one is referred to the table. But for the purpose of the exams, normally the tables will be given. Yeah? And you can use this method or you can use this one to calculate for a present value. Okay, so the total cost of investments here is 6115, 6715. So the first journal entry is to record for the investments, debit investment, credit, consideration that you are using the cash, deferred liability, and also shares capital. And then the second one, this one is to record for the investment. The second one is to record for the acquisition expense. Since the acquisition expense is not yet paid, so you're going to use a payables because it's not yet paid. Okay, so credit a payables account. So we have done this one. Okay, so this is to prepare considerations at the acquisition state. So once you have acquisitions, parents and subsidiary relationship, the first thing that you need to prepare is to prepare a group account. Yeah? You need to prepare a group account of a parent immediately means that the parents going to prepare a group account immediately after it's acquired at a subsidiary. Means that at the acquisition date, they need to prepare the group's account. At the acquisition state, the net asset value of the subsidiary must be stated at their fair value. All the asset and liability should be stated at fair value. Okay, to fair value to the parents. Consider adjustment necessary to revise the book value to the fair value. So because the items that you have in the balance sheet is normally at the book value. So once you want to do a consideration, you need to make an adjustment. Okay, from the book value, we're going to use a new value, which is a fair value. So you need some adjustment. There may be create a revaluation. So you need to revalue the assets. Okay, and then you have pre-acquisition adjustment. Okay, for pre-acquisition adjustment, parent investment in the subsidiary as stated by purchase consideration or COR here is cancelled and substitute by the underlying fair value of the net asset of the subsidiary. So we're going to change or substitute the COI here. Okay, you're going to substitute the cancel. So cancels here, you need to credit your COI, and then the debit side here is the net assets, net asset of subsidiary. So remember that the net asset here is equal to the equity, equity of the subsidiary. So that the net asset of both company are added across and presented in aggregate to avoid double counting in the group's accounts. So we're going to add that one together. Okay, the consideration procedure. The first thing you need to, okay, investment in a subsidiary account, which is COI, cost of investment, is cancel or eliminate. Again, the shares capital and pre-acquisition reserve of the subsidiary, leaving the balance as a goodwill. So you're going to debit here. Okay, this is your investment COI. You're going to cancel. Cancels means that you're going to credit this one. And then the debit side here, you're going to eliminate it with a shares capital, and pre-acquisition reserve is the equity, and then the balance here will be a goodwill, which is your asset. Asset, that is a new asset. Okay, the new asset that are created during the acquisitions. Okay, okay about this one. Please remind me at the beginning of the class and next time. Okay, sorry about this one. Okay, so this one is the one that you had last time, yeah, so you don't miss anything. Okay, so again, I just repeat this one, the procedure that we have here. The first procedure here, we need to eliminate the COI, cost of investment. We're going to cancel it. Cancels means that you need to credit. Okay, sorry. Okay, we're going to credit the cost of investments. We're going to credit this one. We're going to credit the cost of investment. And then for the debit side here, we're going to cancel it again. Again, shares capital here is the debit side. Shares capital and pre-acquisition reserve of the subsidiary. And then the balance here will be a goodwill. Okay, the financial statements of parent and subsidiary are combined on a line-by-line basis by adding together assets, liability, equity, revenue, and expense. So remember that you have a financial statement for a parent and also financial statement for a subsidiary. So once you become a group, you're going to add all the elements that you have in the financial statements of the parents, add together with the financial statements of subsidiary, including assets, liability, equity, revenue, and expense. Just need to add line by line. Line by line here, for examples, revenue in the parents, okay, going to add with the revenue in subsidiaries. Okay, let's say revenue in parent is 1 million. Revenue in subsidiary is 0.5. So the total revenue for the groups here will be 1.5. So this is what it means by add together line by line. We're going to add the same items together between parents financial statement, add together with the item that you have in the subsidiary financial statements. Okay. So now this is a new one. We're going to continue the new notes that we have here. So now we're going to look at the issues here. The issue that we have in the consolidation at the acquisition date. So the first issue here is relate with the goodwill on consolidation. Okay, the second one is a revaluations of the subsidiary asset. The third one is a non-controlling interest, and then the last one you have a reserve. So 4 issues that relate with the acquisitions, consolidations at the acquisitions dates. Okay, we look at the first issues here on the goodwill. Okay, the goodwill here is a difference between COI, NCI, and also the net or the compare with the net or the fair value of identifiable asset, liability, and contingent liability, which include assets or liability that the acquirer had not previously recognized as asset and liability in its financial statements. Okay, so the goodwill here is calculated as a purchase price. So purchase price here is combination between investment by parents, okay, plus investment by NCI, plus investment by NCI become a purchase price minus net identifiable asset. So net identifiable asset is here is asset minus liability, which include asset which is not yet recognized. Any asset, okay, plus any assets or liability which is not yet recognized. Recognized. Okay, so this one you need to find the net identifiable asset and then use the word fair value here. Fair value here means that this asset and liability should be measured at fair value. So net identifiable assets here, in other words, when you have assets or liability here, is equals to the equity items. Okay, so that is the good ways on how to calculate the good ways here. The investment by parents add together with the investment by the NCI minus the fair value of net identifiable asset. Okay, the acquirer shall, at the dates of the acquisition, recognize goodwill acquired in a business combination as an asset. The goodwill become an asset. And then this goodwill will be recorded at cost. It will be recorded at cost. And then after the initial recognition, the acquirer shall measure goodwill at cost less any accumulated impairment because there is no accumulate amortizations for goodwill. Yeah? Okay, so at the first phase, at the acquisition date, okay, the goodwill should be measured at cost. Okay, after acquisition date, okay, the value of goodwill here, goodwill at cost, okay, need to minus impairment, accumulated impairments. If there is accumulated impairment loss, if you have that one, then you're going to have the goodwill, the amount of goodwill. So this is at the acquisition date, we only use a goodwill at cost. After the acquisition date, the value of goodwill need to minus if there is any accumulated impairment loss. Okay, so we try to look at this example. Example 2. Okay, same example that you used in example 1. Yeah. So now this time ABC acquired 100%. So wholly owned. So means that there is no NCI here. Okay, on 1st of January 2017, amount paid here is 6715. Yeah? Okay, this is the statements of financial position for a subsidiary here. Okay, if you look at here, they have a shares capital and reserve. So these two items is considered as an equity, yeah, because long-term liability, long-term loan here is a liability. Okay, and then for asset, they have two types of asset, PPE and net current asset. So altogether you have 7. So this is an asset. Okay, now we want to determine, based on this information, we want to determine net identifiable asset. So remember that net identifiable asset here is your asset minus your liability, okay, which is asset 7. Your liability here is 2, so you're going to have 5. Or net identifiable asset is asset minus liability, which is equals to the equity. So for equity, we have 2 for shares capitals, okay, shares capital, and then plus 3 here for the reserve. So altogether we have 5, the same amount. Yeah. So this is your net identifiable asset. Okay. Is it okay with this one? Yeah. Any of you? Any questions that you have? So this is to determine. Yeah? The first step, when you have this one, just determine what is the net identifiable asset. Is it okay? Any of you there? Is it okay? Are you still there? Okay. Yes. Okay, so proceed now. Okay, so this is what you have. And then it said that all items are recorded in the account are assumed to be recorded at fair value. So means that we need no need to do for adjustment because that is already at fair value. Okay, so the questions ask you to calculate the goodwill and then prepare the consolidation journal entry. So we need to calculate the goodwill here. The goodwill here is the difference between purchase price. So in this case, the purchase price is only the cost of investment by parent because the parent hold 100%. Yeah? Minus net identifiable asset. So the cost of investment paid by parents here is 6715. Yeah? 6715. Okay, and then the net identifiable asset that we have here is 5 million. So we already calculated previously. So the goodwill that you have here is 1715. Okay, this is like the one that you have in here. Okay, so you have your COI, COI, because in this case, we don't have NCI, so means that parents own 100%, parent own 100%. So we just use COI here. Okay, so COI minus net identifiable asset. So how to calculate net identifiable asset? Either you are using the equity or asset minus liability. Yeah? So you have 5 here. So goodwill here will be 1715. So prepare the journal entry. So debit, remember that for the journal entry, we're going to cancel your COI. Okay, so COI or eliminate. Eliminate your COI means that you're going to credit your COI. So credit your COI. Debits here will be your net asset. So the net assets here is equal to your equity item. So you're going to have shares capital, 2, reserve, 3. So altogether you have 5. So the difference that you have here is a goodwill. So the goodwill here will be transferred as an asset in the segments of financial positions in a parent's accounts. And so this is what you have for the goodwill here. Okay. So we proceed with the goodwill. And so the second one is to eliminate. Okay, eliminate the COI and recognize the goodwill. Okay, and then it said that goodwill here we have two situations here. Either we have a goodwill or we have a bargain purchase. In the case when the COI is lower than the fair value of net identifiable asset, the acquirer need to reassess the value, identification and measurements of the acquired identifiable asset, liability and contingent liability, and the measurements of the cost combination. And then after reassess, then you can need to recognize immediately again in the profit or loss any excess remaining after the reassessment. Okay, so in the case here, you're going to have a goodwill here when your purchase price here is more than the net identifiable asset. Okay, then this one you're going to recognize as an asset. Okay, in the case when the purchase price or the COI here is lower than net identifiable asset, we're going to have a bargain purchase. But before this bargain purchase is a gain, is a gain. Okay, but before you can recognize a gain, because accountant is conservative, before they can recognize a gain, you need to do two things. The first one, you need to reassess again whether there is a difference or whether there is a mistake in the fair value determinations or the fair value of the asset, or maybe in terms of the measurements of the cost COI, so need to reassess. And then if after you're satisfied with your the reassessment, then after that you can recognize a gain. So this gains here will be recognized in your income statement. Okay, only gain. A gain can be recognized after the reassessment. Means that when you find that your purchase price is lower than net identifiable asset, okay, you're going to have a gain. But before you recognize a gain, you need to reassess again the value of the assets and also the COI. Yeah? And then if you're satisfied with that one, then you can recognize that gain. That gain will be transferred immediately to your income statements. Yeah? Okay, but most of the time, we don't have most of the time we are going to have a goodwill instead of having the bargain purchase of bargain purchase. Okay, so any question for a goodwill? Simple, sir. You need to know the formula to calculate for a goodwill, which is the purchase price. Purchase price here is the cost of investment minus the net identifiable assets. Okay, any question for goodwill? If not, we just proceed with the next one. Okay, the next one we have the second issue here is related with the revaluations. The revaluations of the subsidiary asset. Okay, the identifiable assets or liability and liability of the acquired entity should be restated at fair value. You need to restate it at fair value because in the statements of financial positions, most of the assets and liability is stated at the book value. So for the purpose of acquisition, we need to change that one to fair value. We need to restate it to fair value. The consolidations journal entry depends on whether or not the subsidiary has made a required adjustment in its own book value. In its own books. So you need to look at whether they already make an adjustment or not. If there is no adjustment, then we need to make an adjustment. Adjustment here is adjustment that refer to the changes from book value to the fair value. Yeah? Okay. So we try to look at example 3. So example 3 here, the same thing, still 100%. Okay, which is same amount. Okay, now same thing that we have here, the same information here. Okay, this is additional information. Okay, said that include in the fixed asset of XY Berhad was a freehold property at a cost of 1 million. At 1st of January, this property had an open market value of 2 million. Okay, if you look at here in the balance sheet or segments of financial position, the property here is recorded at 1 million. But at the acquisitions date, okay, the value become 2 million. So there is an increase in value by 1 million. Yeah? So now the fair value become 2 million. So means that there is increase by 1 million. Yeah. Okay. And then also said that others identifiable asset, which is granite extraction right, worth 500 as at 1st of January will not reflect in the account. So will not reflect in the account means that this is others assets, others identifiable asset, which is granite extraction right. So granite extraction right here is the intangible assets. Intangible asset. That intangible asset is not yet recognized. Not yet recognized in the financial positions. WXY financial positions. So since the asset is not yet recognized, we need to recognize it. Okay. Others items. Okay, others item recorded in the account are assumed to be recorded at fair value. Okay, so if you look at here, in the segments of financial positions of the company, we have here, okay, we have PPE. If you refer back, the PPE that we have here, okay, asset that we have here, PPE at 4 millions, 4 million. And then the other ones, non-current asset at 3 million. Okay, so it said that, okay, a net current asset, okay, PPE 4 million. From that PPE 4 million is the book value. Okay, now the fair value of parts of that PPE here, we have a freehold property. So now the value of freehold property has been increased by another 1 million. So we need to add another 1 million. So now the PPE become 5 million. So non-current and net current asset still at 3 million. But we have a new asset here, which is intangible asset. Okay, intangible asset, another 0.5 million. So altogether we have 8.5 million. So now the net assets of the company here, not the net asset, the total asset of the companies here is 8.5 million. So the liability that we have here is 2 million, no changes in the liabilities here. So means that the net identifiable assets here will be 6.5 million. Okay, so the questions want you to calculate the goodwill and then prepare the consolidations journal entries. Okay, now the net asset become 6.5. Yeah? Okay, this is the calculation that we have here. Okay, the freehold property, the book value is 1, now become 2. So the difference here 1 million. So 1 million is considered as an increase in value, revaluation. So increase in revaluation surplus. Okay, intangible assets here, before this, 0 because we not yet recognized. Okay, not yet recognized. Okay, so the value is 0. Now it becomes 500. So this one is your new asset. So the new asset that you have here. You need to recognize this one. Yeah. Okay, so the goodwill of consolidation is calculated based on the COI. COI here is 6715. Okay, now the fair value of your net identifiable assets here becomes 6.5. 6.5 here from the fair value of PE here, 4 plus 1 here become 5. Extractions granite here is a new asset that you have here, 500. The net current asset, no changes here, and then minus your long-term loan is your liability. So you have 6.5. So the difference between these two figures here is 215. Yeah, so 215 here is a goodwill on consolidations. Yeah. Okay, if you compare previously, the first example in example 2, isn't it? Example 2 or example, so, okay, in example 2. Okay, in example 2, it seems that your goodwill here, okay, previously your goodwill is 1715, example, previous example. During that time, your net assets here, net identifiable assets here is only 5 million. So it's the one that you can say here based on this example, you can say that when there is an increase in net identifiable asset, it's going to reduce the amount of goodwill. Yeah? Okay. Okay. When there is an increase in the identifiable asset, we're going to reduce the amount of goodwill. Yeah? Okay. So recalculate for the goodwill here. So the goodwill here will be 215. Okay, the next one is to prepare a consideration journal entry. Yeah? So consideration journal entry. Going to debit your PPE here. PPE here because there is an increase in the value, and then you have a new asset. Okay, the new asset, intangible asset 500, and then you're going to credit a revaluation surplus. Revaluation surplus here means that the increase in the asset, the fair value of the asset. So increase in the fair value from book value. So book value change to the fair value, and then there is increase. Okay, for example, here for PPE, previously book value is 4, now become 5. Okay, and then for intangible asset, okay, the book value is 0, now becomes 0.5. So means that there is an increase. All of this increase will be transferred to a revaluation surplus. Okay. So we have increase in the value, so means that credit your revaluation surplus. Okay, so revaluation surplus, we put the word pre-acquisition. Pre-acquisition here is at the dates of the acquisition, there is an increase in the value. So it said that to adjust the book value of the net asset to fair value at the acquisition date. Okay, the first one is to adjust the book value, okay, to recognize for the changes in value. Okay, the first one, recognize the changes of value from book value to fair value. Okay, the second one is to prepare the eliminations. Okay, eliminate here. So the first eliminate means that you need to credit your COI. So credit your COI here, 6715. The debit here is a shares capital, equity, shares capital. Yeah, the equity section. So you have shares capital, reserve, and then this is a new item. The item that you have here is a revaluation surplus. All these three items is under equity. And then this is a new thing, which is a goodwill, is a new asset. So and okay, this goodwill only exists at the acquisition stage. So this goodwill cost as a goodwill on consolidations. It become a new assets in the company, in the groups. Okay. So any questions that you have up to this one? Okay. Between goodwills and revaluations of subsidiary asset. Any questions that you have here? Any of you have a questions? Okay, so So proceed to the next one. Okay, the third situation. So the third situation here when we have an NCI. So an NCI is exists when the acquirer, okay, when the acquirer has less than 100% interest in subsidiary. Okay, for example, here is parent acquired 70% in subsidiary, so the NCI will be 30%. Any non-controlling interest in the acquirer is measured either at fair value or based on the proportionate shares of the acquirer net identifiable asset. So that there are two methods to measure the NCI, either using the fair value method or using a percentage of net identifiable asset. Percentage here is percentage refer to the percentage of share owned by the NCI. For example, say 30%, like this example. So that 30% time with net identifiable asset. So we have two methods to measure the NCI using a fair value method or proportionate methods. So we try to look at example 4. So for example 4 here, the same thing. Now ABC acquired 80% at the price of 510. So the COI here will be 5100. So 500. This one is by parent. Okay, and then the fair value of remaining 20% interest, which is NCI here. Okay, the NCI here, NCI have 80% for parent, NCI have another 20%. Okay, so the value here is on 1275. Okay, so means that the total purchase price that you have here is 6375 because we add together COI and NCI. Yeah? Okay. So this is the value of the asset. So prepare the relevant consolidated journal entry at the acquisition date using both method. Okay, both method for NCI. Yeah? So NCI here, two method, fair value and proportionate. Yeah? Okay, if you look at here, there is a net identifiable asset. In this case, NIA here. NIA here is 7 minus 2. We have 5 here. So using these figures. Okay, now we're going to prepare relevant consolidated journal entry, assuming for both method. One is fair value and then the other one is professional. Okay, so this is what you have for to calculate a goodwill. Okay, to calculate a goodwill, the first method is professional method, and then the second method is a fair value method. This one is to measure the NCI. Okay, we look at the professional method first. Okay, the COI, this one is to find a purchase price. Okay, purchase price here is combination between COI and NCI. Okay, COI here 5.1. Okay, the NCI here. NCI is calculated based on the percentage here. Percentage NCI here is 20%. And then time with net identifiable assets here is 5 million. Okay, we're going to have 1 million here. Okay, total all this together, the purchase price that we have here is 6.1. 6.1 compared with a net identifiable assets here is 5. So the goodwill on considerations here will be 1.1. Yeah. Okay, this one is NCI at net asset. Okay, the second method here is NCI at fair value. So NCI at fair value here, you are using the fair value here. So altogether you have 6375. Okay, compare with the net asset. Net asset is 5. So you're going to look at there is a difference. Now the amount of goodwill become 1375. Why we have a difference here? Because of the difference in the value of the NCI. So the NCI here, this one is only 1 million, but this one become 1.275 here. Okay, so there is a difference in the amount of goodwill. Okay, so to prepare a journal entry, the first journal entries here is using the NCI at the proportionate shares of net asset. Okay, so the shares capital, this one is for parents. So for parents, shares capital, COI here 5.1. The shares capital here, the total shares capital in subsidiary is 2 million. So 2 million time with parent shares. Parent shares here is 80%. So you're going to have 1.6 million. And then reserve 80% time with 3, so 2.4. And then goodwill here is 1.1. Yeah, so you total up here. So the balance here will be goodwill, which is 1.1. Yeah. And then for NCI here, the amount of investments that you have here is 1 million. So 1 million here, 20% time 2 for the shares capital, and then time 3 for reserve here. Altogether, you have 600. So for you to remember that if you are using NCI, okay, NCI at proportionate percentage of shares, okay, shares of net asset, then they said that there is no goodwill for NCI. Okay, all the goodwills that we calculate here is only for parents. Okay. Remember this one, very important. Okay, if you are using NCI, it's based on the proportionate shares of net asset. There will be no goodwill for the NCI. Okay, and then the second method, if you look at the fair value, okay, if the goodwills NCI is at fair value, okay, for the parents will be the same journal entry like the proportionate of shares. Okay, but for the NCI here, you look at the NCI. NCI now the investment on NCI is 1275. From that 1275, we're going to allocate to shares capital 400, reserve 600. Altogether, you have 1 million. So 1 million here, we still have a balance of 275. This 275 become a goodwill. Yes, so remember this one. If the NCI at percentage of shares of net asset, then there is no goodwill. If the NCI at fair value, there is a goodwill. Okay, remember this one. Okay. But for the parents, both journal entry for parent, will be the same journal entry. Same journal entries. Same amount of goodwill, same journal entry. The difference here is only for the NCI. Okay. Any questions that you have for this one? Have any questions? Okay, we just proceed with the last one for the reserve. Okay, for reserve, last one for the issue. Okay, so we look at the reserve here. So reserve can be categorized into two part or two types here. Either that one is a capital reserve and then a revenue reserve. Yeah, so reserve is a part of the equity. Yeah, in preparing a consolidated financial statement, reserves need to be differentiated into two, which is a pre-acquisition reserve and then post-acquisition reserve. Pre-acquisition reserve is any reserve that arise at the acquisition date. Okay, at the acquisition date, it's not belong to the parent, so it need to be eliminated each time when preparing consolidated financial statement. So every time when you prepare consolidated financial statement, you need to eliminate the pre-acquisition reserve. Okay, the second one, you have a post-acquisition reserve. So post-acquisition reserve is a profit or loss that earned by subsidiary after. Refer to the profit or loss that are earned after the acquisition date. After the acquisition date, so the parent have a share in this reserve, and then it's depend on the percentage of ownership owned by the parent in the subsidiaries. Okay, post acquisition reserve and a parent entitled for that one. So how much they entitled for the profit or loss? It depend on the percentage of the ownerships. Okay, we try to look at these examples. Okay, now LM have 100% interest. So 100% interest. So this is the amount that you have at the end of the acquisition date. Shares capital 50, returns earning. Return earning here is a reserve, parts of the reserve. This one is pro what kind revenue reserve. So this one is a revenue reserve. Okay, we have returns earning 20 and then revaluation reserve is 10. Now it come to year 31st December 2017. The amount here, shares capital remains, but returns earnings has been increased to 30. So it means that you have a push of increase by 10, yeah, increase by 10. Compare with this one, increase by 10. This one has an increase by 5, yeah. Okay. Now we need to classify that reserve into two. And then that one is a pre-acquisition reserve, and then the other one is post-acquisition reserve. Okay, for pre-acquisition reserve, return earning we have 20. Revaluation reserve we have 10. But for the post-acquisition reserve, it become 10. 10 here, where to get this one? 30 minus 20. Yeah? Okay, and then this one 15 minus 10. Okay, this pre-acquisition reserve need to eliminate. Okay, this one going to be recognized based on, you're going to recognize this one based on percentage of interest, interest or shares, interest or shares. Okay, yani pre-acquisition reserve, we're going to eliminate. This one we're going to, for post-acquisition reserve, we're going to recognize it. Okay, that is what you have for reserves. Now we're going to look at example 6. Okay, for example 6, hopefully that, wow, we only have a few minutes. Just try to proceed with this one. Example 6. Okay, example 6, we have acquired 80% interest in Garuda. Okay, acquisition was paid in cash 300 and issue 900 ordinary shares. Suppose that we start at 11:30, isn't it?
Yes.
11:30. I thought at 11, and so that's why. Wait, a few minutes. Okay, never mind. So just like with the example 6, we go slowly on example 6. Okay, example 6 here. Naga acquired 80% interest in Garuda on 31st December. Okay, the acquisition was paid in cash 300. Okay, so now we have Naga and then Garuda here. Okay, Naga have 80% here, means that another 20% is owned by the NCI. Yeah. On 31st December 2019. Okay, the acquisition was paid in cash 300. Okay, so consideration COI here using cash of 300. And then the shares capital here is 900 at 1 ringgit per share. So 900. So altogether you have 1.2 million. That 1.2 million is for the COI. Yeah? Okay. And then the market price of Garuda shares on this date was 1 ringgit and 50 per share. So this is the market value of the company of Garuda. So the market value of the company here is 1 ringgit and 50 cents. All identifiable assets and liability of Garuda are stated at fair value. All the assets are stated at fair value except land. Okay, except land was revalued at 450. Okay, we look at lands for the accounts. Okay, the land that we have here in Garuda here, the value of lands here, if you refer to the next slide 62 here. Okay, the value of land that we have here in that segments of financial position is 400. Now it become 450. So means that there is a revaluation surplus of 50,000. Yeah? Okay, and then it said that the non-controlling interest was measured at fair value. So once the non-controlling interest is measured at fair value means that there is a goodwill for NCI. Yeah? Okay, measure at fair value. So measure at fair value here, you're going to measure at fair value of Garuda. Okay, so Garuda, based on the Garuda value. So this is the statements of financial position. So this is what you have here. So we're going to focus on Garuda because Garuda here is a subsidiary. Okay, so information here, if you look at here, this is the net asset that they have. Okay, and then this is the shares capital. Okay, if you try to total up this one or you want to calculate this one, 1750 to find the net assets here. Okay, 1570 minus 120 and then minus 70. At the end, you're going to have, which is equals to 1380. Yeah, this one. If you total up these two figures, also 1380. Okay, this one is before adjustment. Okay, now we're going to look at the adjustment. So the first requirements here, you need to calculate the cost of investment, prepare related journal entry, calculate goodwill, consolidations entry on 31st December 2019, and consolidated statements of financial position. Okay. Okay, the first thing you need to calculate the COI. Actually, we already calculate for the COI. So this is a COI here. Cash that you paid 300. Fair value of the share is 900. So altogether we have 1.2. So 1.2 here is at the rate. Your parent shares here is 80%. Yeah? Parent have 80% shares. Okay. So now prepare the journal entry. So the journal entry, you're going to at first place here, you're going to recognize for the investment in subsidiaries at cost. Yeah, cost. Okay, the investment debit the journal entries here, debit investment in Garuda or investment in subsidiary. Okay, better for you to put the names of the company. Yeah, instead of using investment of subsidiary, better for you to put the names of the company because maybe this parent may have more than one subsidiary. So you get going to debit investment in Garuda using this method. Yeah. Okay, 1.2 and then credit cash 300 and also credit a shares capitals of 900. So altogether you have 1.2 million. So this one is to record the investment at the beginning. Yeah? Okay, and then the next one, look at the statements of financial position after the acquisitions. After the acquisitions, look at here. The assets of Naga has been reduced. Previously, compare with the information that you have in slide 62. Now you compare with slide 62. Okay, 62. Okay, so slide 62, if you look at here, the cash in Naga here is 460. 460. Then you minus 300 because you use for the COI here. So now the balance become 160. Yeah. Okay, the next one, you have investment in Garuda. Investment in Garuda here is an asset, which is your COI here. Okay, 1.2. And then this one, another thing. Shares capitals here, previously you have 2.1. Yeah? 200 and 2,100,000 and then plus another 900 here, 900 from the issuance of shares capital for the COI here in terms of equity. So you're going to have 900. So now the shares capital become 3 million. So this is the changes here. The right one is the changes. The value of cash has been reduced because of paid for the investment. The shares capital be increased because you issue a new share to borrow shares in Garuda. So become 3 millions now. And then you have a new assets here. The new assets here is investment in Garuda. So this is what you have here. Okay. So the next one, we're going to calculate the goodwill on consideration. So goodwill on considerations here, you need to consider the revaluations of the assets. So the revaluations of the assets means that there is an increase in the land, the value of the land. So means that when there is increase in the value of the land, means that you're going to increase your net identifiable asset also. Okay, so now the value of land has increased by 50 here. Okay, this 50 here consider as a revaluation surplus. Remember that your revaluation surplus is a part of the equity items. Okay, now I want to find the net identifiable asset. Remember that to find your net identifiable asset, we have two formula. Either we are using asset minus liability, or asset and liability here should be at fair value, and then or the equity. So the equities that we have here. Okay, we look at the first one. The first method, look at this one. Asset, we're using this one. Okay, asset minus liability. So your assets here is 1750, the total asset as stated. Okay, the previous one refer to slide 62. So the total amount of your assets here is 157 over 157. Oh, this one is from slide 62. I refer to slide 62. And then plus 50 here. 50 here is the increase in the value of the land. Okay, so now the value of your net assets here will be 1620. Okay, 1620 here minus your liability that you have here, 120 here is loan, long-term loan. And then 70 here is accounts payable. So altogether, you're going to have 190. So 120, 1620 minus 190. So net identifiable assets here will be 1430. This is the first method to calculate. Okay, the second method, you just refer to the elements of the equity. So the elements of the equity, you have shares capitals here. And then this one, you have a returns profit. Okay, or returns earning. And then this one, a new one, which is a revaluation surplus, is a part of your equity also. So now, as you total up here, you will say you're going to have the same amount. Whether you are using the equity item or using asset minus liability, you're going to have the same amount, 1430. So the 1430 here is your net identifiable asset. So now we're going to calculate the goodwill. So remember that for the goodwill here is the COI plus NCI minus net identifiable asset. Net identifiable asset we already determined at 1430. So now the COI, where is my pen? Okay, the COI here we already determined at 1.2. So now we need to determine the NCI. So this is the next step to find what is the value of your NCI. Okay, for the NCI here, method that we are using here is a fair value method. Okay, fair value method is calculate based on the value of Garuda. This is the value of subsidiaries. Okay, value of subsidiary, the shares capital here is 1 million. And then the market value here is 1 ringgit and 50. So you're going to have 1.5 million. So 1.5 million need to time with a percentage of NCI. Percentage of NCI. So 20%. So 20% time with 1.5. So this one is 300,000. So 300,000 is the value of the NCI. Then we can find the purchase price, which is the COI plus NCI. Okay, COI that we have here is 1 to 100. NCI that we have here based on calculations here, 300. So altogether will be 1.5. Okay, so from 1.5 here, this one is 1.5 minus net identifiable asset based on the previous slide, the one that calculates here. So we're going to have a goodwill of 70,000. Okay, the difference between these two figures, 70,000. Because of the NCI is measured at the fair value, we said there is a goodwill for NCI. For NCI. So from this 70,000, we need to allocate between parent and NCI. Okay, how to allocate this one? So now we're going to calculate this one. Yeah. Okay, this is how we're going to allocate from that 70,000. How much to the parents? The goodwill. What is the amount for the goodwill? What is the amount of goodwill to the parents? And then for the NCI, so we're going to calculate based on this one. Yeah. Okay. So this is the total COI paid by parents. Okay, parent paid 1.2 million and then NCI paid 300,000. Yeah? Okay, then for parents here, since parent paid 1.2 million, the shares of net identifiable asset, parent shares only 80%, time with 1430. So parent share from the asset that parent shares here is 1144. So compare with the COI, so minus the 1.2 minus 1144. So the parent share 50,000 from that 70,000. So the remaining here we go to the NCI, or if you want to calculate for the NCI, so investment by the NCI here is 300. Share of net identifiable assets here is 20%, time with 1430, which is equals to 286. So 300 minus 286 here, you have 14,000, or 70,000 minus 56 is equal to 14. Once you know for the parent, then you can calculate for the NCI. Okay. Any questions that you have up to this one? The calculations of the goodwills. I'll just proceed with the next one. If you have a question after this. Okay. So the next one, we prepare the consolidation journal entry. Okay, so for consolidation journal entry, the first journal entry that we need to prepare here, the first one is to recognize for a changes in book value, okay, to fair value. Okay, so we're going to create a revaluation surplus. So in this case, revaluation surplus or revaluation reserve that we have here is the increase in the value of land. So you're going to debit the land and then credit revaluation reserve or revaluation surplus. So remember that revaluation reserve or revaluation surplus here are parts of equity items. Equity items. So debit land, credit the revaluation surplus. This one is to adjust the book value of the net asset to fair value at the acquisition date. Okay, that is the first journal entry. The second journal entry here is to eliminate. Okay, the first one is to record for the changes in the book value to fair value. Okay, the second journal entry going to eliminate. So eliminate here, we're going to eliminate both for the parents and also for the NCI. Okay, for the parents here, we're going to eliminate the COI. Okay, COI here. So going to debit investment in Garuda at the price of 1.2 million. Credit investment, debit shares capital. So the one that you debit here, all this one is your equity. Yeah? So shares capital here, Garuda have 1 million. So 1 million for parent, they only have 80% share. So 80% time with 1 million. So you have 800. So return profit also 80% time with 380. So you have 304. Same thing for revaluation reserve. Okay, for revaluation reserve, 80% time with 50. Okay, 50. So you have 40 here. And then the goodwill on consolidation, so the one that we already calculated previously. So you have 56 for our parents. Okay, this one is to eliminate COI and recognize goodwill. So GOC here is goodwill on consolidation. Okay, to recognize the goodwill. Okay, and then for NCI, this one is a journal entry for parents, elimination for parent. This one is for NCI. So NCI shares here is 300. From that 300, for shares capital here is 200. Profit here is 76. Revaluation reserve 20% time with the 50 here. So you're going to have 10. And then shares of goodwill here is 14. So since we are using the fair value method, there is a goodwill for NCI. Okay. So up to this one, do you have any questions? Okay, because after this we're going to prepare a consolidated financial statement. Any questions that you have? Any of those? Because you still have time here. Any questions that we have here? Okay, okay, so clear about this one. The rest okay, eh? So you understand about this one? Okay, I still cannot remember some of it, just those few of you in this class. Okay, so we proceed. So we proceed to the next one. So the next one, we're going to prepare a consolidated financial statements. Yeah? Okay, consolidated financial statements. Now we only have, look at the titles here. We have Naga groups. Okay, Naga. Okay, Naga groups, parents, yeah, because only parents going to prepare a consolidated financial statement. So parent in this case is a Naga. Okay, so now we said that when we prepare a consolidated financial statement, we're going to add together parent financial statements plus subsidiary financial statements. Means that Naga financial statement going to add together with a Garuda financial statements. Yeah? Okay, so cash in Naga 160 plus 70 is cash in Garuda. So just add Naga and Garuda. The same item, cash add together with the cash. Account receivable add together with account receivable. Inventory also the same thing. And then we create a new assets here is a goodwill. This one is a goodwill on consolidations. GOC. Okay, you have a goodwill here. Total goodwill here is from parents and NCI here, 70,000. And the investment in Garuda here becomes zero. It's zero here because we need to eliminate. Okay, eliminate, so it becomes zero. Land here, add together, and then we have another 50 here because of the increase in fair value. Yeah? So now buildings, just add together. Equipment, also add together. Okay. And then for the equities here, so the equity here, this one is for Naga, this one is for Garuda, but they need to eliminate here. Eliminate here refer to this previous journal entry. This one is eliminated, the one that we eliminate. So we debit shares capitals here, means that debit here we need to minus 800, we need to minus 200 here. Okay. So that's why we minus 800, 800 from a parent, 200 from NCI. Yeah? Okay, so now become 3 million. Return profit here, add together. And then after that, minus, minus 304 for parents. And then this one is for NCI. So it become 880. Revaluation reserve, we start with the 50. And then this one is eliminations, it's become 0. Okay, become 0. Okay, now we have a new items here, NCI. NCI also under equity, so parents need to account for the NCI of 300,000. Okay, and then we have long-term loan. Okay, only Garuda have this one. Account payable, they have both. Okay, so this is what you have for the statements of consolidated financial statements. Any of you have a questions here up to this one? The statements of financial positions here? Any question? Only now Ross there. What about the rest? We have another 34 members here altogether. The rest, what about the rest? Is it okay? Najwa, okay? Okay. Adwa, okay. So we proceed, We proceed to the next one. On how we going to allocate goodwills, yeah? Yeah. Okay, so this one is relate with on how we're going to calculate a goodwill. Okay, not calculate, allocate the goodwill. Yeah? Goodwill can be allocated based on the rates. Okay, if the COI paid by the acquirer is exactly equals to its amount of fair value of the acquired as a whole, the goodwill and combination is calculated based on the rate between parent and NCI. Maybe you can understand this one. Just refer to this one. Okay, we refer to example 6. The COI paid by parents here is 1.2 million. Okay, 1.2 million you need to check here. Okay, the first one you need to check the value of Garuda. Okay, the value of Garuda here is the subsidiary. So the value of subsidiaries here is 1.5 million. Okay, 1 million times with 1 ringgit and 50. Okay, and then the fair value of COI in Garuda here is 80%. 80% is owned by parents, yeah? 80% times 1 with 1.5. So we're going to have 1.2 million. So the amount that you calculate based on the fair value here is equals to the COI. Then we can use a rate to calculate goodwill. Not to calculate, to allocate goodwill. Okay, rate to allocate the goodwill. So based on this one, you already calculate that the goodwill here is 70%. So once the goodwill of 70%, you since the COI, the main things or the main requirements here, the COI should equals to the fair value of the subsidiaries. Yeah? So once you already check for this one and then you already fulfill this criteria, the COI is equals to the fair value of the subsidiary, then the goodwill can be allocated based on the rate. So the rates here is 80% and 20%. Just time this one. This one makes it simple. So 56 and then this one will be 14 just based on the rate. So you don't have to prepare like this one. You don't have to prepare this table. Okay, no need to prepare this table. No need to prepare this table. Okay, this table, you don't have to prepare this table if the COI here is equal to the fair value. COI of parents here is equal to the fair value of the subsidiary. Okay, the COI, how to calculate this one is a percentage of parents time with the value, fair value of subsidiaries. Okay, you need to check this one. You don't have to prepare this table if, okay, if the COI here is equals to the fair value of the subsidiaries, yes, then you can allocate based on the percentage. So you know that the amount of goodwill is 70,000. So 70,000 you just allocate for the parents just time with 80%, and then for the NCI just time with 20%. No need to prepare the table that I showed previously. Okay, so this is okay with that one. We can use the rate with a conditions that if the COI is equal to the fair value of the subsidiary. Okay, another case here is when you have a premium. A control premium is the amount that a buyer is willing to pay over the current market price. Okay, you pay more than the current market price. Okay, willing to pay more than the current market price of the acquiry in order to obtain a control. Yeah? In such case, goodwill is not allocated based on the rate. You cannot allocate when there is a premium here. You cannot allocate the goodwills between parent based on the rate, but shall be allocate. The first thing that you need to do here is to allocate the goodwill to the parent based on the difference between COI and the fair value of net identifiable asset. Then the balance of goodwill going to allocate to the NCI. So means that we need to prepare the table that we showed previously. Yeah? In the case of when the parents pay more than the value of the subsidiaries here. For example, here we are using the same examples here. Okay, assuming that the market price here is RM1.50, but Naga willing to acquire RM1.80, which is more than the market value of Garuda. Okay, they acquired more than the market value. So they need to calculate the investments here. So investments here is 1 million times with RM1.80 times with 80% here, 80% here. So 80% here, they're willing to pay at 1.44. Suppose that based on the value of the Garuda here is RM1.80 times with 1 million, time with 80%. So they suppose that they need to pay only 1.2 million, but in this case they pay more. Okay, willing to pay more. So when the parents willing to pay more, okay, and they're willing to pay more, so the goodwill here going to allocate. The first thing you need to calculate the goodwill. So find the amount of goodwill. So amount of goodwill here is the purchase price, is the COI plus the NCI. NCI remain at 0.3 or 300,000 here. So the amount that you paid here is equals to 174. 174, and then the net identifiable asset is only 1430. So the amount that you have here is 310. So this is the goodwill. So to allocate the goodwill here, the first thing you need to allocate to the parents, and then the balance here going to allocate to NCI. Yeah. Okay, so we need to calculate how much that we need to pay to the parents. So parent, this is the COI by parent minus net identifiable asset, NIA. Yeah? NIA, so 80% time with 1.43. Yeah? 1.43 is the net identifiable assets. Yeah? So you're going to have here is 296. So from that 310 minus 296, the remaining balance that you have 14 here is going to pay to the goodwill for the NCI. Yeah? So this is what we said that, okay, if the COI is equal to market value of the company or the subsidiary, then the goodwill can be allocated based on the percentage, based on the rates here, 80%, 20%, depends on the rate by parents and subsidiary. But if the parent paid more than the market value of the subsidiary, the goodwill, the first thing that you need to do here is to find the goodwill. Okay, and then how to allocate the goodwill here? Allocate the goodwill to the parent first. Okay, based on the COI minus net identifiable asset. And then the remaining balance here going to allocate to NCI. So the remaining balance here, 310 here minus 296, the one that you're going to allocate to. This one is to parents, so means that the balance here is to the NCI. Yeah? Okay. So any questions that we have here? So means that we are already at the end of part 1 of your notes. Huh? Any questions that you have here? I'm saying try to searching for your attendance for a while. Yeah, I just want to look at either the item, your photos is okay or not. If you have any question, please. While I'm searching for your portals here, whether we can have your attendance or not. Okay, if you have any question, I'm still here. Just want to find your share. Okay, I'm going to share that one. There. Any other questions that you have while I'm searching for your attendance here? If there is okay with the portals here. Any questions that you have here? Any question from the one that we discussed previously? No question. Please, for the next class, please make sure that you read for the second parts of your notes. Okay, the second parts of your note. And also, I think that second parts of your note take about half an hour to finish with that one. Okay, and then also is study on the topic 2, because topic 2 we're going to start with the intra-group transaction, when we have a transactions between parent and subsidiaries here. Please make sure that you understand the first parts of your notes. Okay, the issue on consolidations regarding the parents, regarding the consolidations here. Okay, just want to share with you the attendance once again for those who not yet scanned. Okay, so you have to know the details about the issue, the issue on the consolidations here. We have 4 issues here regarding the goodwill, how to calculate the goodwill here, the difference between the purchase price. Remember that the purchase price is including the COI and the NCI. Yeah? Okay, goodwill minus the net identifiable asset. And then the second one is about the revaluation of subsidiary assets. When there is a change, revaluation here means that we're going to look at the book value. Okay, going to change from the book value to the fair value. If there is increase in the value, we need to record as a revaluation surplus. Okay, during the revaluations, there is also need to recognize if there is a new asset exists at the acquisition state. Okay, and then for revaluate non-controlling interest. Okay, for non-controlling interest, we have two methods to calculate for non-controlling interest. Okay, we have either the proportionate shares of the net asset, means that there is no uh, goodwill. And then the second method is a fair value method. So fair value method for the NCI, we're going to have a goodwill for the NCI. And then the last one, you have a reserve. So for reserve, we have two types of reserve: pre-acquisition reserve and post-acquisition reserve. Pre-acquisition reserve is reserve that exists at the acquisition date, so we need to eliminate that one. The post-acquisition reserve is reserved after the acquisition date, and then parent have a shares on that post-acquisition reserve. Okay, so and then please look at again example 6. Try to understand example 6, because the example 6 is combinations of the issue that you have in consolidations. Okay, and then for the next class, we're going to continue with topics 1. Okay, continue with topic 1, part 2, and topic 2. Maybe introduction for topic 2. Be careful, topic 2 is a little bit difficult as compared to topic 1, because now we're going to start with the intra-group transaction. We have transactions between parent and subsidiaries. So prepare for this one, for topic 1, part 2, and topic 2. Okay, any questions that you have? And then one more thing, I got to mention to you that we already changed our mid-sem exam. Mid-sem exam on 23rd of April, which is on Friday, 9:30. So for your mid-sem, Okay, Friday, Friday morning instead of, because on that 27, with some of your friends has a exam, statistic. So you need to change that one. Handwritten. For those asking about the tutorials here, all of the things that you need to submit to me except for the project should be handwritten. Okay. Anything that you submit except for project. The rest is all handwritten, and just write that one and I scan. Table, what you need to do, the table, or it's okay to, what table? Oh, just a normal one. This is not an exam. Exam, so like 55 and 56. What you have for 55 and 56? Table 55, 56. What do you have for that one? Table. Okay, you just prepare a journal entries, yeah? Tables. Table is only for you to calculate this one, yeah? Make sure that you know how to calculate that one. Okay? Shazimi, okay? Just prepare a journal entry. But show your calculation, okay? Show your calculation. It's not necessary in a table. Maybe you just a simple one, not like a draw, like a table, say, but you need to know, show your calculation step. Okay. Any other thing that you have here? No. Oh, do you have a share best plan? Okay, for this one, I need to discuss with coordinator regarding this one. But for the time being, you just choose the company based on the list that are given. Okay, but in the case of the company that do not have a share-based payment, okay, I'm going to discuss and get inform you for the next class regarding if whether you can choose another company beside the company that allocate to your groups. Okay. Other than that you have? Other than that? Okay, for those who do not have a question, so it's already 11:23. If you want to leave the meeting, you can leave the meeting for the next class. Okay, so if you still have a questions,